I'm excited to see all the names, if not faces, just to kind of say that this is a very friendly group. We're all friends here, so this should just be a really, casual and open conversation. We are very excited to talk today about opportunity zones. Obviously, it's been alive in our community for quite some time, and folks have a lot of questions and interests. So today we hope to be able to provide a good technical overview and explore what some of the risks and challenges are that we're seeing, and then how to best leverage this opportunity if possible. And so we have some folks who can share some models for engagement and how to kind of best maximize this opportunity. And so just to kind of give you a sense of how our time will be spent today, we're going to spend 15 minutes where we'll get to hear from the three folks who are joining us to share a little bit about their work and experience with this thus far. And then the next 30 minutes, we'll open it up for a Q&A. I'll have some specific questions for them based on some discussions that we've had, and then open it up to everyone else. As Catherine said, she'll bring those questions into the room on your behalf. And then for the next 35 minutes, then we just want to have a generative conversation. So hear a little bit about kind of how you all are experiencing opportunity zones, if it's something that, if you have zones that have been designated already in your communities, or, specifically some of like the challenges that you're seeing, or also how you all are dealing with it in your community as well. So we're just, excited again just to have this be an open and casual conversation. So with that, I'd like to thank Aaron, Stephanie, and Tomas for joining us to kind of share their work. Aaron Seibert is from the Kresge Foundation, and Stephanie Gripney is from Impact Finance Center. And we have Tomas Duran from Concern Capital, who's also a BALLE Fellow and board member. And we had a great conversation with them, I guess, a few weeks back, just to kind of learn a little bit more about their work in this space. So we're excited for them to be able to share that with you. So Aaron, if you want to kind of kick us off, I know you particularly are looking at how this is actually fitting within a traditional marketplace. But if you can give us a little bit of an overview of what this is and isn't, and then, how Kresge is kind of responding to this opportunity.
Sure. And just quickly, Kresge is a $3.7, $3.8 billion private foundation in Troy. We work nationally in 6 different program areas, and then I work on the social investment team, which means I'm the PRI making arm of the foundation. So the work that I do is focused on generating impact, getting my money back, and hopefully generating a little bit of return on it, but in that order. So we get attracted to opportunity zones and the legislation because we thought that it could potentially fill a dire need in the community development space, which is the need for equity, both at the project level and the enterprise level. And it's a unique opportunity to attract equity investments into our sector in an impactful way. I will also admit that I have a lot of anxiety around the program and some of the maybe unintended consequences that I think could have pretty dramatic and negative consequences for the places that we care about as a foundation. So, from my perspective, the opportunity zone legislation is really designed to create a new marketplace. It is not a program, from my perspective. It doesn't look anything like a government program. It's not CDBG. It's not new markets. It's not low-income housing tax credits. There is no federal subsidy that is being monetized in a private marketplace that is a scarce resource and that goes to fund effectively project finance or enterprise level finance. It's not built that way. I think the way it is built on very bare bones looks a lot more like the private mortgage interest deduction as a private incentive to encourage private investment in a certain, in this non-program, it's in a geography. The original legislation and the writers of the legislation, the lobbying from it, pretty well, felt that this was really to address growing economic inequality, and they view a lot of the reason for that growing economic inequality is flow of capital, and that flow of capital into places where there are new business starts really looks like the coasts and then like Austin. And that a lot of the country was missing out on venture and private equity that is used to grow and scale businesses sort of in those coastal areas. So they're trying to remedy that and create an incentive to address that disparity in capital flow. I think what we are seeing is some of that, but also some unintended focuses on real estate. We put out an RFP with the Rockefeller Foundation to invite potential fund managers in. We received 140 some applications. I suspect some of the folks on the line are applicants. The bulk of those were real estate based. The bulk of those assume that the capital will come in as a concessionary tool, very cheap equity. And most are pretty mission-focused organizations, although we had large corporate investment banks apply and large private wealth management firms and other things like that. So it's a wide variety, and I think the market is going to reflect that. I think from Kresge's perspective, what we're going to do moving forward is going to be in 2.5 pieces. Of those applicants that we had come in that are major scale investors, folks who manage large amounts of institutional capital, have very robust platforms for raising and deploying capital. We're very concerned about the ability of this capital to sort of do harm in communities that we care about. So we're going to try to make a trade where we de-risk their funds using our balance sheet and put our name on their funds as sort of a good housekeeping seal of approval. And in exchange, we're going to try to extract some terms from those fund managers that aren't present in the legislation as it sits now. And want things like accountability and transparency and some fidelity to outcomes and some data analysis and evaluation. On the other side of the fence, we had a lot of tightly mission-aligned organizations. And I should say those folks, we think they can raise $100 million or more and probably work nationally. The folks that are more local-based are more tightly philanthropically aligned with the foundation's programs, but probably need a lot of help in creating and managing an equity fund. We're going to provide technical assistance to them through grant making, through a single sole source provider, and then hire them a lawyer, an accountant, and fundraising capacity so they can take their concept, turn it into an offering memorandum and a fund model, and take it to market. And those platforms are largely based on an investor that is socially aligned with them and is likely willing to take some concessionary yield on their investment. The large fund managers are almost entirely built on a model that is not concessionary capital in any way. And so we're sort of trying to address both the size and scale of fund managers, as well as the different kind of investors that we think are going to play in the marketplace. And then my other sort of half leg of the stool is I think that equipping communities around advocacy, states and localities and nonprofit organizations around how to advocate for, get their claws into this thing so they understand the way that the capital is coming into their communities. I think some sort of, I don't want to call it a policy platform, but an advocacy platform is something that we're going to spend some time thinking about. So I think that's my 5 minutes.
Perfect. Thanks, Aaron. Thank you for sharing all of that. Stephanie, I want to turn it over to you. And I know you have some kind of innovative ideas and approaches that you've been working on in Colorado.
Yes, thank you so much, Leslie, and thank you, Aaron, for that great overview. I'll put on 2 hats. I'll talk about what we've been doing in Colorado just around place-based impact investing for the last 4 years in Colorado, and why it's essentially a precursor to a strategy, a way, a toolbox to source opportunity zone fund investments that have deep and medium social and environmental impact. So we have 2 nonprofits. We have Finance Center, and that nonprofit has essentially spent 75% of its time training individuals, donor-advised funds, communities, philanthropists, investors, corporations, how to do impact investing. And so now annually, we will have our big place-based conference in March. We'll have probably 300 to 400 philanthropists and investors who have done either their first or second direct investment locally show up. And we've done 170 educational events around the state. And that has resulted in about 30 classes because most nonprofits don't even know that they have impact investments in them, whether that's a line of credit, a mortgage, refinance, making an asset like a building more efficient or a social enterprise. So we have a small business impact investing class, a nonprofit impact investing class, a startup impact investing class. And so we've been doing those classes all hundreds of times around the state of Colorado. And now when we do a call for social ventures without the opportunity zones, we typically get 100 to 300 investment opportunities that are high risk, low risk projects, nonprofits, startups, small businesses, and funds. But the interesting part is we haven't done a GIS overlay of it, but I'm guessing 80% of them would qualify as opportunity zones fund investments. We've just happened to have been doing this for 5 years. We've just started doing the evaluation. Our goal was to catalyze $100 million of investment over the last 3 years, and we've already counted 251 investments for $201 million, and we've only counted 40% of the data. So we've essentially created a farmer's market think of it like investment opportunity zone investment opportunities. So we've been focusing our time on growing the impact investors to invest in the social ventures, and 25% of our time growing the social ventures. And during Impact Days, which this will be March 12th through the 14th, set up a physical farmers market, and we'll have a one-day opportunity zone summit. And the opportunity zones have come online, that the same methodology of awareness, education, and activation of the philanthropists and investors and the social ventures can be used to source opportunity zone fund investments in a community that are high impact areas, and also grow the impact investors. So I'll stop there, and that's those two nonprofits are the Impact Finance Center and Colorado Impact Days. And I'll say the two interesting things we're doing is we weren't going to apply for the LOI, but it forced us, we were asked to, and it forced us to kind of rethink of equity. And so our two innovations that we put in is one of our partners put in, you don't have to have private equity of a small business in terms of ownership of the business. You could actually have private equity ownership of a revenue stream. So you could create revenue-based financing and not own the actual small business or company, but actually own part of the revenue stream coming off of it, which could be a better alignment of growing wealth within the stakeholders of the actual company and leaving more wealth. Another one was our partner said, why not do a small business loan lending where, yes, you might borrow $40,000 and give up 40% equity of your small business, but as you pay back that loan, you buy back your equity. So really kind of trying to reimagine what's possible if we have to use the equity model under the opportunity zones. How do we restructure equity so it's actually aligned with the small business, the startup entrepreneur, so that it's not extracting wealth for the investors, but leaving that wealth in those communities. And the last thing I'll say is the tool we've been using and expanding in Colorado probably around is a tool of using an impact investing giving circle. And there's 1,400 formal giving circles within the US right now, housed at community foundations. Meanwhile, there's this awesome immigrant lending circle tool called the TANDA as an example. And what we're saying is let's bring the TANDA Impact Immigrant Lending Circle in and combine it with a community foundation impact investing giving circle. And so why that's exciting is, for example, Memphis, we might have funding to expand our work in Colorado to Tennessee. You can basically combine the opportunity zones and say, how many philanthropists and investors care about Memphis social ventures, projects, nonprofits, for-profits, and funds, where they would like to get experience doing their first 3 to 5 direct investments for less than a $5,000 tax-deductible donation with a group of their peers. And so you end up getting 20 to 60 philanthropists and investors forming a formal giving circle. You do the courses, you also teach the philanthropists and investors, and then when you do the call for social ventures, you're like, who needs money? You typically get 50 to 150 social ventures. And why that's exciting is that's kind of a participatory impact scan that uses more of a bottom-up community approach to not only source the social ventures, but source the philanthropists and investors that would be investing in the opportunity zone. So I'll stop there and and wait for questions eventually.
Great. Thanks so much, Stephanie. All right, Tomas, I know you're deeply focused on the economic development space. So how are you kind of viewing opportunity zones in your community? And you're on mute right now, by the way, Tomas.
All right, how's that better?
Yeah.
I think the great challenge that we see in economic development, so I agree with Aaron, that it's a tool. It's not a program. And because it's not a program, there's a lack of accountability associated with it from the people who are putting it out there. And I also agree with Stephanie that it is a tool that could extract a lot of wealth from the low-income communities where it's eligible. The conversations that I'm hearing, especially from the investment circles, is that they're salivating over a lot of these opportunities because they're in areas like downtown LA or other built-out urban areas that during the 2010 census were significantly had lower economic development, lower economic status, and now have recovered, and they're like easy picking. So the concern I have is that it's a tool that will increase gentrification rapidly, and I think that there's opportunities to push back against that if it's used correctly. And I think that the great challenge is going to be is how do you find ways? Sorry, I'm putting this on you. How do you find the right ways and the right partners to use this tool if you even decide to use this tool at all? I think for a lot of the people in this space, you know, if you're working with an entrepreneur or a small business, a Main Street small business, and they need $50,000 to $150,000 in capital, you can use other things like crowdfunding to crowdfund debt for them. If you're looking at larger businesses that needs much more debt and they also have an equity need because they're trying to buy real estate or trying to do other things, then this could be a tool, but you're going to need partners like what Aaron is talking about or Stephanie's talking about in order to really make sure that your impacts are, your investments are impactful. And always keep in mind that they're investors. There's an expectation for something coming back to them. And oftentimes in this space, their expectations are market return. And I believe Stephanie mentioned in the last call we had that she's able to adjust those expectations, and I think that's brilliant. But my concern really is that the scale of this is going to be so large that if you're not aware of what's happening in your own backyard, it's going to accelerate gentrification, increase wealth gaps, and create a whole host of other problems for us. I think making it clear about what you're trying to accomplish in your particular community, in terms of what you're trying to do with the Main Street revitalization, or you're trying to do with supporting entrepreneurs in a particular space or an opportunity zone, and working with groups like Aaron is key, because that's what's going to help you move forward. Now, I'm looking at also from the perspective of manufacturing and increasing opportunities within the manufacturing space. And in that space, what's going to end up happening is, just because of the way business works, is you're going to end up with a lot of roll-ups, a lot of consolidation, a lot of relocation of businesses from one place to another. There's people coming to me asking about relocating businesses out of the Midwest into other areas that are opportunity zones and how that makes sense for them because of the long-term investment. And it's going to be one of these where I push back about moving jobs out of one community into another.
Mm-hmm.
So it's going to be, there's a number of different challenges surrounding this, but I do think there's definite opportunities, but you have to have the right partners and a very clear focus to what your outcome is going to be.
Excellent. Thanks, Tom. Yeah. Thank you, Tomas. So we definitely are, you know, hearing about, you know, what are some of the things that, you know, we need to look out for, and how can we try to best leverage this opportunity, if we can call it that. And partnerships is definitely key. So looking at who, you know, we're partnering with on the ground. And I'd love to hear from you all, what are some other things that people could be thinking about right now as we're gearing up for opportunity zones in the legislation? You know, when we don't have all the details yet, but how can the community start preparing best for it today? And I'll open that up to either Stephanie, Aaron, or Tomas.
I think
I'll
it's
throw it.
Go ahead.
No, you. After
you. I would just say that, you know, with other opportunities like the New Markets program, where you have a oversubscribed resource and everyone's competing for that treasure, clearly articulating the benefits of that program beyond just, you're going to save this building, you're going to save this business, but the impact of those kinds of jobs, using the language that can resonate with the investors, that make them feel like they're having an impact in their community is key. I think the other part is finding those investors that want to make a significant impact, and having those relationships, developing those relationships, and being able to offer them the benefits of the program and understanding what those look like is also key. But again, this is not, I wouldn't recommend this is for the faint of heart. I mean, this is something you really got to come prepared for. I mean, Stephanie, I think, gives us a great example of the amount of work that I think it takes to put into creating a really successful program.
Mm-hmm.
I would just add, I'm on ventures about what the impact investors are looking for, as if it's milk chocolate or dark chocolate. And I said, just like you, social venture, you're like a unique caramel chocolate, salted milk chocolate, and somebody else is a dark chocolate with some spice into it. The impact investors are exactly the same way. And one of the problems is we all need to identify what kind of chocolate we are in the box of chocolate, whether we're a social venture or an impact investor. And the impact investors haven't had as much pressure to identify what type of chocolate they are. And the other issue is when you're in the social venture, it'll be really frustrating because you'll meet, when I say an asset owner, a philanthropist or investor with $50 million, and they might know that they care about women and social justice, and they might be super intelligent, and they might have access to $50 million, but in reality, they've never done a direct investment. And so they're actually at I use a baseball analogy, they're at the T-ball Little League. And these opportunity zone fund investments are really a AA, AAA, major league type of investment. And so it really is frustrating for the social venture when it's like, wait, you look like you should support me. But what we're not doing from a social venture perspective is realizing that they're not at a major league right now in terms of experience. And that's why the impact giving circles are so critical, because how do we give philanthropists and investors with over $10 million experience that matches where they're at? And that's why it's exciting that we have a new learning by doing executive ed class to say, hey, let's get you with 20 to 40 peers that care about a community of interest, place, or identity, and say, you get to get your first 3 to 5 direct investments for a tax deductible donation with your peer group. That's social, fun. And unlike your other giving circle, if the money comes back to the donor advised fund, we just recycle it and do it again. And so we're missing each other because the social ventures have a need for them to be major league impact investors, when in fact they're really at the T-ball level. And so until we put a lot more work into investor education and reducing the barriers to entry, giving them a first safe, good investment and growing more of them, that's when we start to see, excitingly, what we have in Colorado, where we now have dozens and dozens of active impact investors. So the odds that a social venture can find 1 or 2 for that initial seed investment is much higher.
I think the only thing I would add, and I agree very much with that approach to the impact investing space, I just always would encourage everybody to think about this from an investor that is aligned with impact, and then an investor that is ambivalent to impact, that where impact is not a relevant factor to them. And to think about what makes your community attractive to invest in for an investor that is not interested or disinterested, but is ambivalent on the social impact perspective. Is there an approach to alignment of resources to state and local incentives or otherwise that would attract an otherwise socially ambivalent investor? And also to think defensively about if your community has say from a real estate perspective has low-cost assets, but like a rental market that is appreciating rapidly, that's a market that is primed to attract this kind of capital that could really accelerate displacement. If you have a high concentration of sort of underperforming or low-performing manufacturing sectors with a lot of family-owned businesses that are prime target for equity buyout, and that could lead to transition of leadership and potentially a relocation of businesses from one place to another. I mean, there's lots of permeations of that, of those sort of two concepts where assets are relatively inexpensive to buy and maybe higher value in other places, or higher value if they take on different physical characteristics that may or may not align with your goals. And so while I think this will be an impact investing tool, I am also very convinced that it will be a not impact investing tool. And to think about your approach to opportunity zones both opportunistically and defensively.
Great. And I think, Catherine, you were pointing out that Ellen had a question that was kind of along the lines of what you were just speaking to there, Erin. Do you want to share that a little bit?
Sure, yeah. So Ellen's question was around whether there are regulations that should exist or already exist to try to prevent these folks from extracting wealth and causing displacement within communities.
No, there's not. That's the simple answer. There's not. We've got the federal sin businesses baked in, and that's about it. And I think that, I know for a fact that there are already people working on ways to get around the sin business prohibition. We'll see if they're successful in doing it. So no, there's a whole, if I had my druthers, right, this would look a hell of a lot more like a government program, because I'm very uncomfortable with the lack of guardrails in this thing, but it's not what it is. So I think our play in this is really trying to create norms inside of an emerging market. There are lots of things that exist in financial markets all over the place that are not regulated to be such, but they have just become the practice and the habit of market participants. So we are trying to stand up first movers that adopt certain principles and ensure that the investor community is conditioned to expect those principles, if nothing else, for reputation risk concerns. I don't know if we're going to be successful doing that, but in the absence of regulation, we are trying to address those things that I mentioned: accountability, transparency, some statement and fidelity to outcomes, data collection, dissemination, and evaluation, just like basic level things that should have been in the legislation from my perspective. We'll see if we get another bite at this, but that's what we're going to try to do.
Great. And, curious, because a lot of the folks who have, Tomas, did you want to say something?
Yeah, I'm sorry. The implementation, the application of this tool, actually in the investments, if you're looking at investing in operating business in a low-income community, you're still going to need debt. This is only the equity piece. And this equity piece may be 20 to 30%. It can go higher, but it's still a low-income community. So the debt side is going to be controlling a lot of, or affecting a lot of what happens here. And so there still may be a need for additional support, additional subsidy, and those additional subsidies may trigger things like prevailing wage. They may trigger other things that would force the investment to be more accountable. So what I would encourage the participants is to look around and see what are the active programs, economic development programs in your space. What are you considering? What would a project in your area need? Because keep in mind, this is not going to 100% fund. It will not 100% fund what you want to do. You need other pieces of the capital stack. And if it's going to be an SBA loan that's part of that, you're looking at 40 to 50% for an operating business, maybe a little higher for real estate, but you still need other sources of capital. So I think in terms of the application, is my little glimmer of hope that we'll still be able to affect how things happen on the ground. But it's going to take a very informed community to make it work.
Great.
Awesome. Yeah, and I just wanted to lift up Melanie's question in the chat box. She asked whether there are national impact investing groups or firms that are putting together investors that local social ventures could access, and then especially for states and localities that don't have a whole lot of investors, but do have a lot of opportunity zones that are slated to come online soon.
I mean, I can try again. Yes, definitely. I mean, I know of plenty of sort of national social impact platforms that are going to try their hand at this. I think what concerns me, and this is certainly more Stephanie's world, she would better be able to answer this, but my impression when I have pressed them about where they are going to get the capital from it sounds a lot like the same people we already know. So, a lot of the times they're raising capital from banks and institutional investors that are CRA motivated. They are raising capital from DAS and high net worth individuals that are already socially motivated and sort of in their platform and in their space. What I have not heard is a recognized national impact investing firm or platform that believes that they are going to get significant amounts of capital in the sort of socially ambivalent space to come over into the impact investing space and take concessionary yield for it, right? Like they can go out and deliver a 12% yield and that's what everybody's going to try to do. What I haven't heard is somebody say, we think we can get the people who don't care about the impact that we make to either care about the impact, well, really to care about the impact and then take a 2% return, right? Or a 5% return or something quite concessionary. I have not seen that yet, other than people coming to us and asking if we would do that. But right, we're already in that space and we don't, there is no excess impact investing capital in my world. Every dollar gets used for something. So it's really more like arranging the deck chairs. I'm not saying it's not going to happen, but I have not been convinced that that is the reality of the marketplace right now.
Definitely, I was going to say, looks like you.
I would concur with Erin. A lot of the big organizations or CDFIs are looking at this project by project. So they want to get something going. So instead of doing a national affordable housing, multifamily affordable housing fund or medical real estate, they're looking at one-off transactions. Those are existing entities with exactly what Erin just said, existing sources of capital, not necessarily bringing in new forms of capital. If you go around to the different governor's offices conversations, so there are non-impact private equity, VC, real estate firms that are basically saying, great, how would we, I want to be careful how I say this, but how impact light would we have to be in order to put our money into opportunity zones? Is this a way for us to extract wealth if there's no rules? So we could pretty much come in, increase our financial returns and reduce our basis and do the same thing we're doing, but go into gentrifying communities. So I would say there is non-impact capital looking at the opportunity zones to move into this place, but the place what Erin said is their conventional money that has not been looking for impact, and essentially say money that has been seeking maximum capital gains, that's all of a sudden going to say, oh, now I want to turn around and do a left-hand turn, tie my money up for 10 years in low-income communities and high-risk transactions. That's a pretty heavy lift to expect of that. So we kind of have two roads. We basically have the same two lanes of money running along. The conventional money looking to extract wealth from communities using the conventional private equity, VC, real estate model, and this seen as an additional opportunity. And then the money that's already working in the impact. So those two worlds are still kind of running along in parallel to each other.
Well, and I think, Stephanie, earlier you touched upon this a little bit, but I know a lot of folks from our community are, looking to actually set up community determined funds, and it's in collaboration with impact investors and foundations, and looking at ways for community members to actually be non-accredited investors in this fund. So I'm wondering, what really is the actual viability or feasibility of the community to be able to set up a fund and, determine how it's going to invest as part of this tool?
A couple of ways for my initial response to that. The mentor who taught me finance said the only people who set up funds are people who can't raise capital. So when you start raising up a fund, you have a lot of additional costs. And the minute you pick your target area, you're going to dispel a lot of those chocolates in the box of chocolates, because you're going to pick one thing that's needed. And so my former student, for example, ran the Transit-Oriented Development Fund for Enterprise in Colorado, and he spent a full-time life, raising $30 million around transit-oriented development, versus you look at the work we've done in the last 4 years, and we probably catalyzed 500 direct investments. But we didn't presuppose we knew what that fund would look like. We were looking at one-off transactions. But let me give you something that is hope. I'm working with a medical real estate developer And this is how it could be differently. Historically, medical real estate would work where the investor would come in. Right now, they're getting, let's say, 22, 23% return market rate. The investors come in, they buy the medical building, they lease it to the doctors, 6-year lease. What could happen, but this can happen without opportunity zones too. So the opportunity zones could just make it a little better. What could happen is this medical real estate developer we're working with, what she does is she comes in and she buys that building, and then she does a long-term lease with the doctors. So instead of a 6-year lease, she says, hey doctors, why don't you do a 20-year lease, and why don't you own part of the building? So that way, that becomes an anchor building where they're making a 20-year commitment to stay in that building. They actually own the structure of the building. And what she's wanted to do, she's like, I'm tired of making rich people richer. So she wants to, then you could line up a direct public offering and allow non-accredited investors. She's specifically interested in women growing wealth. But you could say, let's allow everybody in that medical building, from the people, the physician assistants, to the physicians, to the nurses, to the support staff, to actually own part of that investment through a direct public offering, or even the community members. And then let's create a small foundation around that. Then would do really fun additional investments, like creating a 0% student loan program for all of the staff of that medical building. So you can take an existing conventional real estate project, like a medical real estate project, where the investor comes in, gets a good return, extracts wealth, and instead kind of layer it in and saying, let's have not only the stakeholders in the building own the real estate, make a longer term commitment in that real estate community, allow the community members and patients to own a piece of that upside and take part of that profit and reinvest in the community. What's crazy is you don't need an opportunity zone tax incentive to do that work, but it does improve the financial return.
Awesome. Thank you so much. We have a few more questions. So Esther asked, is this a primarily urban strategy, and how do you see it working in rural areas? Tomas, I know you have a little experience about that, and would love to hear other folks too.
So I've been hit up a lot by different entities in rural areas looking to pull together opportunity funds, and mostly what I see happening in that space is going to be anchor institutions, large hospitals, or larger investments that are going to be valued at $10 million or more. Or you have companies that are going to build housing for their workers. Like a lot of the chicken farms need workers nearby, and so they may be building an entire neighborhood of a housing community for their workers and have that operating business be leasing the housing. Or you have public-private partnerships around infrastructure. I think there's going to be a lot of activity from the P3 groups of building new wells, new sanitation, new stormwater, new power systems that are going to be then treated as an operating business and then leads back to a local municipality or local government entity. And this is going to just be one more layer of the capital stack that makes it all work together. But these are still larger investments. The threshold that most people I've been talking to is around $10 million. Part of that is because they want to put the money out and what they see as a viable entity that's of scale for a 10-year period, and then maybe do a little bit of reporting on it, but they don't want to have to go and reinvest that money because that entity didn't make it. And that's one of the things I think is going to keep, one of the barriers that we're going to have if you're trying to do smaller investments in more urban communities, or if you're trying to work with startups. Because of the high failure rate for a startup, your investors are going to look at that, and you have to have a very compelling reason why you're going to put equity into these startups that may not be that traditional venture capital mold, that may not be the traditional type of business that the venture capitalists are interested in. And the challenge for people who are creating those programs that want to do those smaller businesses is that you have to work in a turnover mechanism for when that money comes back to you. Because let's say that you purchase real estate, improved it for an operating business, the operating business goes out of business, you sell the real estate, the money comes back, you got to put it back out again. And that takes a lot of work and effort. So there's a number of challenges that are going to keep, I think, the investments at a pretty high level. But it doesn't mean it's impossible. It just means that if you want to attract something different, then you need to have a program that gives the investors or the vehicle that's making the investment reasonable assurance that you can help them reinvest or find them new projects to put their money out that's going to be performing, according to their standards, like Aaron was saying earlier. Hopefully you find that group that wants to do it 2, 3, 4, 5% return, and they're willing to work with you on that. But if not, they're still investors. So I think Esther, there's going to be a ton of activity. I think you'll see a lot of hotels in resort areas along the Gulf Coast. I think you'll see a lot of, just like I said, public-private infrastructure and housing for concentrations of livestock and that kind of food production that's labor intensive.
Great, thank you, Tomas. We had one more question from Pamela Standing, and then we can roll right into discussion. Pamela is asking if they use census tract data to determine who's an opportunity zone, and noting that this feels like new market tax credits. So Aaron, I know you spoke to that a little bit earlier. I wonder if you could elaborate more on kind of the differences there, and then Tomas and Stephanie, of course, as well.
Yeah, so yes, it is based off the census tract data. They were picked from qualified census tract. They borrowed the language from the New Markets program. I would caution everyone that is where the similarities end. This is nothing like New Markets. It's nothing like it at all. New Markets is closer to LIHTC than this is to New Markets, honestly. And they made those two programs, they could not be more different. The only similarity is they use the same geographic coding, and the sort of data that they used for the evaluation of sort of like the need was the ACS, which, like anybody who spends any time with it knows, is far from a perfect far from a perfect evaluation of the needs in low-income communities. It is a very high-level skimming of sort of population data. So it is like New Markets in that they use the qualified census tract. You could also have designated census tracts that were adjacent to qualified census tracts, which are some pretty bougie areas in some places that were also eligible, and that's where the comparison ends.
I agree with Aaron, but I would add that there's a lot of the New Markets entities that are jumping into the space because they're raising capital from a lot of the same investors that they do for the New Market space. And I think one of the things that you can learn from the people in that space is how they do community benefit agreements and how they try and make their investments accountable to the surrounding area. New Markets tends to favor wages and the number of jobs created, quality jobs, and that sort of thing. So there's a lot of research paperwork and legal work that have been created around how do you define those benefits at the outset of a potential investment, and then how do you keep them compliant, or how do you check for compliance during the 7-year compliance period. So I think there's some of that stuff that we can learn from that space, but the New Markets people love this because the transactions are way less expensive. The amounts are way higher, and there's no limit to the amount of money that you can raise. So if you do know people who are in that space, I think it's worth a conversation around what they may be doing.
Great. Thank you, Tomas, for adding your thoughts to that as well. And I think what we can do now is just transition into the discussion section, because we have some, I think, really good questions that I'd like to actually open up for other folks to respond to as well. And so, as Catherine mentioned before, if you have a topic that you want to bring forward, just raise your hand, and then virtually through the application. And if you want to actually also respond and join into that conversation, likely also raise your hand as well, and so Catherine can bring you in. But I think let's start with Jessica Norwood, if you want to kind of open up your or unmute and share with us your question, because I think there have been some other thoughts that other of the participants wanted to add to that.
Hi, thank you, Leslie. So sure. I think I had a couple of questions going here. Let me see if I can synthesize them a little bit more. But one thing that I was really curious about, thank you to all the speakers, was a little bit more conversation around philanthropy and what you're noticing in the field right now about where philanthropy is landing on this. And I'll take Aaron's buckets and use them specifically in the place around advocacy. One area that I'm really hearing a lot about is people's concerns in the local community about how they interface with these different investors or potential. So what kind of supports or resources are you hearing around the advocacy piece? I think the other part is, where is philanthropy landing as far as helping to make sure that these investable projects get attached to or connected to funds that may be developed. So they wouldn't have the capacity to be raising funds, but they may have an investable project that might be a one-off kind of deal or might be better situated inside of a fund. What's the strategy around helping to position those folks to be able to have those kinds of conversations? And I think most largely there is a vacuum, I think, if you will, around just the technical language around the financial markets, and what kind of support does philanthropy see in helping to make sure that local cities, social enterprises, and so forth are actually even prepared language-wise to be able to have this conversation about what is actually investable, what return might look like, what liquidity might look like. How are they able to actually be in those conversations, particularly if those might be a direct one-to-one kind of deal, not necessarily situated in a fund. I'm thinking about everybody's a T-ball kind of analogy here. So those are the three buckets of questions around advocacy, connecting to other funds, and then how we're supporting people to be able to engage in that conversation through training, language, and so forth, particularly some of those nonprofit organizations that might have qualifying projects or ideas, but because of the language there, just wouldn't be able to articulate that. Okay, thank you.
I probably am the one who needs to answer that, right? I'll try. So I'll try to hit it, but if I forget something, remind me. So what is philanthropy doing? I can tell you what we're doing. I can tell you what Rockefeller's doing. You heard my spiel and the things that I am worried about and the approach that we're trying to take. I'm pretty concerned about the sort of market mechanism, and so we are probably way outside of our comfort zone on this. But if I were to categorize the work that we are doing, it's a lot of risk mitigation and sort of harm prevention. And trying to do a heavy-duty influence campaign to create those market norms, in the hopes that if we can condition the market early to sort of look at certain things and not look at other things, that will create a playing field that is more friendly to the stuff that we would normally do and the folks that we would fund. I know other foundations. I mean, this is like the thing that everybody is talking about, right? I suspect it comes up like 5 times a week for people on the phone. It certainly does for me. So large foundations like us, all the way down to small community foundations and family offices, I think are hearing a lot about this from their grantees and from their investees. But it's a lot of noise and paralysis, right? I mean, what it tends to boil down to, I think, is I've got this thing I'm trying to do, and what I need is cheap money. Can you help me get that cheap money? And as I said before, I'm not really very convinced that there's going to be a lot of cheap money here. It's going to be washing around, at least at the national level. There certainly will be investment capital that is unlocked. Hopefully it is new incremental capital from folks who are on the sidelines that come in, but it may be a reshuffling of the deck from stuff that was going into one thing into another, and hopefully that's more advantageous for our sector. What I continue to try to tell people is the thing that you can tell your local philanthropy, your regional philanthropy, the folks that you have a relationship with, is we have a need for a fund manager that cares about our community, and that could be a locally managed fund, it could be a citywide or a regional or a statewide, but somebody needs to care about us. Somebody needs to be our advocate. And we think we know who that person is. And that's probably whomever you're already getting financing from in some way, shape, or form that is capital constrained. And what they need is funding for technical assistance to go from what is probably their debt practice, right? They probably do debt financing, to put them into the truly managing equity space. And there are some national firms that, Novogradac, Resnick, Plant Moran, from accounting firms, and then all the big tax shops that do the community development work in this country are all out there consulting and doing work for funds. The fund that cares about your place needs an offering memo. It needs a fund model. It needs something that they can shop. And then they need a strategy for who they're going to go to get that cash. We are going to try to set that up through a nationwide intermediary with 5 to 10 of the funds that came in through the LOI to get that started and try to get them off the ground. And if that turns out to be a good model, our hope is that the intermediary that we pick to do that technical assistance and to manage that sort of legal work and accounting work will become a place that, like, XYZ community foundation in whatever city says, we really like this organization, they need TA, here's a $50,000 or $100,000 grant to go to that nationwide intermediary that has experience setting up high impact funds and put them through like a little boot camp or something like that to get them off the ground. So we're going to try to create that. And, I hope it's successful and I hope that it works. Well, I know I forgot something else, but you can correct me. That's what I remember.
Yeah, that was really helpful, Aaron. I threw a lot at you, so it really was on me. And I will bookmark there and leave it there, and somebody else may pick up another thread. But thank you so much for what you did give. I was taking notes. Thank you.
Great.
And Stephanie, go ahead.
Here's what I would.
Here's on Rockefeller as well.
Here's how we're looking at the Opportunity Zone funds. We know we have to grow more impact investors in our communities. So that's where we dug in 4 years ago and said 75% of our technical assistance is actually training the money how to invest in us locally. So the good news is the Opportunity Zone, that you can do that without the Opportunity Zone funds. And so just what we're doing in Colorado is the state is trying to do a double-sided marketplace match.com. So if you have a state doing that, that's going to be one place where opportunities come up. If you don't have a state taking initiative, we also have people on the ground doing meetups, Opportunity Zone Fund meetups, where you can actually be a clearinghouse for opportunities there locally. So if you're in a state that isn't organized, set up a meetup around opportunity zones. If you have resources and a community foundation that wants to go deep into a certain geography, whether it's a rural small community, town, or a city, set up an impact investing giving circle, Opportunity Zone Circle. We're talking to a national funder to do this in 5 or 6 major cities. And by doing so, you can start getting a participatory equivalent of a philanthropic scan, an impact scan, to understand what those opportunities there while you're growing your own Opportunity Zone Fund investors. And then lastly, we've set up a place. So in March, we'll do our call for social ventures, and we'll have 100 to 300 Opportunity Zone Fund investments and physically set up a physical farmers market. But if you're in a state without a lot of capacity, start with a meetup. And if your state is organized, our state's doing education capacity building in a double-sided marketplace. If you want to go deep in a community, set up an impact investing giving circle, which grows your impact investors while providing a scan of opportunities. And then lastly, we're happy to support you doing what we've done to set up the double-sided marketplace of an impact days.
If I can, I just want to add a little bit. I think what Stephanie's doing is impressive. It's incredible the amount of work that her group has put into developing investors in that space, and it's something that I really want to learn a lot more about. I think the nuance here I would add is that the challenge that we have is timing. And once the program goes live and these investments are starting to go out, it's a relatively short amount of time that people are going to want to make investments so they can get their 10-year benefit. And one of the things that I would also encourage people, if you're in a space that doesn't have a sophisticated or evolved or just anybody in that space is doing this kind of work, then I would look into other programs that have national footprints and see if you can convince them to come into your space. trying to create your own programs, trying to learn about this program, trying to find investors, trying to package deals, it's time intensive. And if it's not your space, it's going to be a lot of effort that may not prove fruitful, as opposed to bringing in someone that's mission aligned with you, that is already doing this kind of stuff. LISC has a national footprint. The National Development Association has a big footprint. There's new market tax credit, CDE, that have national footprints that are very civically minded and that are socially progressive, that would love to do projects in areas that give them credit for making investments in underserved communities and in states that they might not have an investment in before. So I think that there's a lot of opportunities besides just creating your own space, and I would strongly encourage everyone to look at how you can work with other people who are already in this space and gain the benefit of their expertise.
Thank you all for your thoughts on that. I wanted to bring in a comment that Lucas made a little bit ago. Lucas, I wonder if you could speak to that a little bit. It was around the avoiding the negative outcomes and the building off of what Aaron had already said around that. I can unmute you. There you go. Yeah.
Thanks, Catherine. Yeah, I just wanted to get any advice or thoughts from folks who are a little further along in their thinking on this as to ways that we can play a little bit of defense. I mean, impact investing as a field generally is becoming more attractive, and I think that's sort of seen in the way opportunity zone funds are going to draw a lot of new players to this space. And I worry about players like large Wall Street firms that are doing impact investing, but truthfully are maybe driving efforts that'll reduce the housing stock through rehabbing buildings and reducing the amount of affordable housing in those buildings, giving great return to investors, but having an overall negative effect. So I think, Aaron, you touched on this when you said that you're going to request more of fund managers than opportunity zone funds would normally, and that's great. And I'm just hoping to dig a little bit into the details of that.
Sure. So from a defensive perspective, you know, when I mentioned to you, the thing that troubles me most about this thing is the lack of transparency. So unlike new markets, right, you're not certified as an opportunity fund in the same way. You self-certify that you meet the obligations by filling out a form and sending it in with your tax return. And those forms, at least as far as I know right now, are not publicly discoverable anyway. There's no database, there's no registration, there's no examination of it. You're at audit risk because what you ultimately have to do is meet an asset test. But there's no like SIS system like there is in new markets where you know who the people are, you know where the awards are, you can like do a FOIA of their application and see what they're trying to do. There's no sunlight on it, and that makes me uncomfortable. So we're going to lean heavy on that transparency around who the fund is, who their principals are, where they're raising capital from. It's also, I think, troubling, or at least it ought to be troubling for a lot of states where they got to pick the zones and then they have no oversight going forward. And so I think for those states that have state level income taxes that have a capital gain component to them, they're all going to be under tremendous pressure from the investor community to align their state tax and taxation system to align with the federal legislation so you get the benefit of both the state and the federal side. I think that is a great opportunity to create some accountability and transparency metrics at the state level by requiring folks to register as an opportunity fund and disclose where they're like deploying capital. You know, there's lots of different ways you could go about doing that. For those places that don't have that kind of state taxation scheme, I think it's really up to local communities to think about what are the tools and incentives that we currently use to draw in private capital, and how could those tools and tax abatements and resources, whatever they are, be tweaked, changed, modified to bring some sunlight to opportunity zone investments in their communities and to both incentivize them right through a series of carrots and then potentially some sticks to ensure that local priorities are being heard out in sort of the way that capital is flowing in those places. I don't know what that's going to play out. I wish I could be more specific with you than that. But you know, in the absence of that sort of thing, most of these communities you're never going to know whether or not an opportunity zone was ever investing in your community in any way, shape, or form, be it, you know, real estate or small business or private equity or whatever. It's just going to look like money. And there's no way to know what the impact on your community is going to be, or even at the federal level, because there is no central database registering investments and investors and returns and that sort of stuff.
Thanks. That's really helpful. Good for us to think more about what we can do on that state regulation piece. So yeah, thanks for pointing to that.
I just want to add that, we still have all the remedies of a public process available to us. And I think one of the things that will happen when there's going to be large-scale investment in a community that hasn't seen it before, or that's in an area like Aaron said earlier, where they're trying to drive capital to an area that just hasn't happened before, you still have the public process that project has to go through. So if you want to push back against gentrification, if you want to push back against a number of these things, then you kind of have to be aware of that process and aware of where things are and interject inside of it. Because Aaron's right, it's not transparent at all. I mean, it's a very opaque program. And if you're not in the circles that are talking about where the money's flowing and how it's flowing, you're just going to miss out on the conversation.
Great, thank you all for your thoughts on that. I got a question from Nancy Darren around whether or not community land trusts would be a good fit for this as well, and how the interplay between opportunity zones and community land trusts might be able to manifest itself. And just as a reminder to if you want to kind of contribute to the conversation and can't figure out how to take yourself off mute, you can raise your hand, which you can do so by clicking on the participant tab at the bottom of the Zoom screen. And then in the bottom right of that list, there should be a button where you can raise your hand virtually, and it'll pop up for me. And I can unmute you as well.
I just have a follow-up clarification question. Does she have a specific transaction she's thinking about? So here's the good news. If a transaction currently works in real estate around a conservation land trust, it will work with the opportunity zones. If it's marginally working because there's not access to capital and this could potentially provide an extra boost for that, that could work. But without having a specific type of transaction that they're thinking about, it would be easier to answer that question. So this isn't creating new transactions. This is just changing the financial returns of existing transactions, if that is helpful.
Well, I think the key thing too is it has to be an operating business. So a land trust that's purchasing land and not doing anything with it, it's not going to qualify. You have to have some sort of income associated with it, and it's got to be a reasonable amount. So if they intentionally do not want people to land bank with it. So a land trust that's purchasing land and then creating, having that be the basis for co-ops being, utilizing the space on top of it, yeah, that could work. But again, it has to be an operating business that has active income.
I agree with both. The only thing I will add is I think you got to think about who your investor is, right? Your socially motivated investor who is aligned with your impact. And yes, if it works for the real estate deal, it should work for this. It's like new markets in that way, in that you can do anything except for the things you can't. But if you think about a socially ambivalent investor, the land trust is somewhat designed to frustrate the appreciation of capital as opposed to create it. And that's not to say some smart lawyer can figure that out, but my guess is, from a socially ambivalent investor perspective, it would not be terribly appealing because it's designed not to allow that capital to appreciate dramatically and create some large gain at the back end, so the incentive doesn't do much for them.
Am I here? Can anyone hear me?
Yes.
Yeah.
Is that you, Nancy?
Hi, this is Nancy. Sorry, I'm on a phone, not the Zoom. So, yeah, I'm just trying to wrap my head around potentials because the east side of our town and our county has been named an opportunity zone, and that's the African American side of town, and then rural, just a lot of rural area. But there is a new community land trust just forming right now, which is all about affordable housing, which of course is a crisis here as everywhere else. And they're just getting set up now in the beginning, and there's also an incredible neighborhood association in one of the historic Black neighborhoods, and they're hooked in with Habitat for Humanity. But as someone said, it's all around folks who would already be interested in mission focus. I don't know exactly how to ask it. So are these zones opportunities that could help actually get this community land trust, which is gathering huge excitement from the city, the county, the housing authority here, it's in a CRA district. So all kinds of things I see as potentials, but I don't know if it's appropriate. And there's also an abandoned grocery store that we could make into a multifaceted, amazing small grocery and food hub and clinic and, you know, the whole 9 yards of that. So I'm trying to learn enough to understand, is this a direction that's worth trying to pursue? Because there is not much of any infrastructure, anything down as far as looking at mission investing, let me say that. I'm sorry to ramble so much.
Not at all. Thank you for your question. Curious if any of the speakers have any thoughts.
I'm trying not to talk so much. You guys are making me.
Well, and so to me, given that we're in such a baby step mode here in North Florida, to tap into someone who or a fund that does have the expertise that would help us. Our community foundation isn't that large, and my knowledge of it is it's pretty traditional in its thinking. And we have University of Florida here, but they are really, they're that capital you were talking about that's not interested in mission at this point.
So I'll try to answer your question. I mean, I guess I would say first, don't feel like you are behind the ball, because I don't care what anybody says. Nobody is experienced in this yet, right? This thing is 5 minutes old, and the regulations, like the first tranche of regulations, haven't even been issued. So there isn't anybody who has like got this thing figured out. There are definitely funds that are out to market, but I have, you know, a dozen offering memos on my desk that did not come in through the LOI process that are just sort of market rate, you know, privately managed funds. And they're basically, what they say is, here's the thing that I do for a living, and I'm going to keep doing that thing I do for a living, but I'm also going to provide this kicker of the opportunity zone thing if it works out. So there's nobody out there that like really knows what they're doing with this thing yet. People are all still trying to figure it out. So I don't think you got to feel like you're behind the game in any way. You know, for small communities, or for long disinvested, you know, I'll just sort of be honest with you. I think that they are most likely to attract capital, if at all, from aligned investors. I think that if you think about just sort of the dynamics, or the way that the incentive works, right? It is designed to attract capital to a situation where you can invest a small amount of money, and at the end of 10 years, or maybe slightly longer than that, you sell or refinance or transact or whatever, you create a liquidity event and end up with a big pile of money. And the bigger that pile of money, the better the incentive. And so capital tends to flow to like the lowest risk, highest return, lowest friction opportunity. And because there are so many of these zones across the country, my guess is, just sort of knowing the way the capital moves, we're going to see it flow to a lot of the same places with a lot of the same dynamics, because it allows for that capital appreciation. Now, that is not to say that small communities and rural communities will not benefit here. But I think the things that make them attractive for economic development and for community development and bring other dollars in, right? Like, and I think the point was well taken earlier that, you know, maybe this is 30% of your capital stack if you're lucky. The other 70% has to believe that this is a good idea. And whatever it is that makes that 70% think it's a good idea are probably the same reasons that are going to make this 30% think it's a good idea, with maybe some tweaks to it. It's, you know, again, it's not a government program. There's no money here. All there is an incentive to change people's behavior. And that incentive, you know, is fully reliant on, well, mostly reliant on people's belief that if they put in money today, 10 years from now, it'll be worth a lot more. And that growth will be tax-free. And so therefore I should do it in this place versus some other place. I would love somebody else to give an opinion on this, though.
Well, I know in the chat, Melanie mentioned some comments and thoughts around it. Melanie, I don't know if you'd be willing to speak to that. Maybe.
Or maybe not.
All right.
Melanie, are you trying to come in? Oh, okay. Mm-hmm.
Yeah, I was going to say I can just, oh, there we go.
Can you hear me now?
Yes.
Yes.
Okay, great. So I'm definitely not an expert, but somebody had asked about the land trust and other involvement. And so I think it was mentioned earlier that you can, equity can be given just for specific parts of a business, so not the business overall. So I know we're really interested in, like, how do you mitigate community change? So particularly around businesses that have buildings in communities, like the buildings themselves are important to try and keep in the community and keep affordable in some way, even if a different business comes in later. So one thought was to separate the physical asset from the business itself. So could you move the physical, as part of the deal, move the physical asset into a land trust, whereas you're putting like the equity itself into the business. So the business and then the physical asset maybe become two separate things. So thinking about, like, if you're saying manufacturing, moving around maybe into opportunity zones or out of other areas, I think was mentioned, you know, those spaces would be good to protect long term. So it might be interesting to try and divorce the two, where the community is getting something, maybe as part of a benefits agreement, where that, you know, the physical property and asset is moving away from market control, whereas the business itself is taking on the equity deal. I don't know if they would be open to it or not, but particularly depending on what investors you're looking at and kind of like what other financial options might be available. I don't know if that's what you're referring to either in my comments, sorry.
Yeah, that's exactly it. Thank you.
You.
I'm sorry, go ahead.
Oh, I was just going to say thank you. The pooled funds idea, I really want to learn more about that. So to be continued at some further point, I guess. But thank you.
Wonderful. And I also just wanted to, Jessica Norwood had to step out, but I wanted to bring in her comment as well. She noted that some investors, when it's concessionary, they'll compare the return to the max amount that they can get for a philanthropic gift. So they'll compare it, and it may be that they end up giving a gift instead, because the capital gain savings isn't more than the gift percentage. Yeah, Stephanie.
Sorry, getting unmuted. Just to give you some happy inspiration, 2012 and 13, when we were starting our effort in Colorado prior to opportunity zones, we started looking for opportunities within nonprofits. And we now outline them as refinancing existing lines of credit, financing or refinancing mortgages, doing energy efficiency in buildings, social enterprises. And so we kind of have like left the word market rate concessionary on the sideline, because technically, as a real life example for our local museum, they had a mortgage that was an arm that was expiring. So we worked with the museum to to get a foundation and 2 donors to take grant money at negative 100% financial return, do a 1% loan for the mortgage, which technically gives a 1% program-related investment or 1% mortgage out of your negative 100% return money is 101% financial return on fixed income plus a tax deduction, save the local museum $550,000 a year. We then took that same model for energy efficiency of a shared space of a nonprofit center, used it to catalyze the Denver Foundation Impact Investing Program, did a $9.5 million loan out of a donor advised fund at 1%, 101% financial return plus a tax deduction, saved the nonprofit $6 million a year. Then we taught Colorado Trust how to do impact investing. And they, for example, invested in Mi Casa, which provides support services for the Latino community, nonprofit, and for-profit community. And they had an opportunity to create a social enterprise to provide bookkeeping services for small businesses and nonprofits. And then we had more complex transactions like pay as you save. So there's a ton. We believe there's $50 billion of nonprofit deal flow in nonprofits just in a state like Colorado. And as we have 8 of our 18 community foundations now doing some form of direct investing, either out of their standalone bucket of money or through their donor advised fund program or through SRI. And our goal is to create negative 10% buckets of money and negative 50% buckets of money, because as I like to tell people making investments out of their donor advised fund or their program officer bucket, you know, a negative 85% financial return is a 15% return on your money plus a tax deduction. And so we would rather talk about financial return, impact, risk, and liquidity, and kind of leave the normative words at the table and say it's about alignment of capital. Get clear on what type of chocolate you are in the box of chocolates, and then put out in the world of what you're looking for, and you can do lots of good stuff. And I'll leave you with one last example. I was with the community foundation, and the CFO was lamenting. They said, "But Stephanie, I have to get a 7% return out of this $350 million so the program officers can give away the grant dollars." And I said, "Do you really? What if you take $1 million of your grant dollars at negative 100% and $1 million of your endowment dollars at 7%, put them together, reunite them again? Now you have $2 million that needs a negative 53.5% return on its investment." And so that takes a lot of education and capacity building to grow your investors to become that way. But that's what we've been doing. And the first 3 or 4 transactions took 3 to 4 years in our community. But the last several hundred have been kind of rolling in the last 2 or 3 years.
Thank you, Stephanie. And I think one of our participants just had a quick question, if you could explain a little bit further more about the negative returns model.
Sure. So I'm going to put my Impact Finance Center hat on, and we work all over the country. So a $1.25 billion foundation came to us 4 years ago and said, "Stephanie, can you teach us about impact investing?" And we take a very broad term. We have 44 tools in the toolbox. So we say, "Are you talking about your endowment?" Because we have governance and investment beliefs and decision-based attribution evaluation. 2 of our tools just identified a $100 million foundation in the Pacific Northwest was spending an extra $1 million 5 years to lose $5 million. So we have manager diversity. We have a bunch of tools there. Or are you talking about restructuring your grant making to save your nonprofits money and grow your endowment? Or are you talking about a program-related investment, your first direct investment to a project, nonprofit, for-profit, or fund? And they said, "Stephanie, we just want to do our first nonprofit loan." And we say, "Fantastic. What was the financial return on your endowment, your $1.25 billion? And they say, "About 5%. So they're essentially paying an investment consultant, 0.5 to 1% fee to ship that money outside of Colorado to invest. It's not knowing what the impact is." And I said, "Okay." I said, "How much money did you give away in grants last year?" And they say $35 million. And I ask them, and I go really slowly, and I say, "Can you tell me what the financial return of a grant is to the foundation?" And they look confused. Sometimes people say 0, nothing, you do it for impact. And I said, "No, it's a financial return." They said 0%. And I said, "Well, last year, the MacArthur Foundation gave my nonprofit a $20,000 grant. Wouldn't a 0% return mean that a year later, my nonprofit, we would give MacArthur Foundation back that $20,000? And they're like, you're right, that is a 0% loan. So what happens when the MacArthur Foundation gives Impact Finance Center $20,000 and we keep it forever? And they say negative, and we say yes, negative 100% financial return. We say it doesn't matter if you're high income, middle income, or low income. We've all bifurcated our money and forgotten that our philanthropy is an investment with a negative 100% financial return, and all of our investments have impact. And then we teach them by going through their grant making portfolio and say, what do you give to? Partial scholarships, school facilities, economic development, hospices. And we say, why are you giving the school $1 million grant at negative 100% financial return when they have a $5 million mortgage public bond financing of the school at 6 to 12% interest? You've had a tax incentive since '69 to give them a $5 million mortgage at 2% interest out of your negative 100% money, which will give you 102% financial return, grow your endowment, recycle your principal for another school, and save that school millions of dollars of interest. And I have this online. Anybody can send me a note, and I'm happy. We have 30 classes. We're putting our first online lesson in. If anyone wants to go to sleep by listening to me speak for 4 hours, we're happy to share.
Thank you, Stephanie. Well, we're at about our time, so I just wanted to invite Aaron, Tomas, and Stephanie to share if you have any last thoughts for this group based on obviously where kind of their interests and curiosities are, just to give you no more than a minute each. Tomas, do you want to share some final thoughts?
You want me to speak for a minute? Oh my gosh.
Let's.
I think the final thought the party thought I would leave is that the great thing about the Opportunity Fund zones is that they're pretty wide open. The negative thing is that they're pretty wide open. And it may not be the panacea or the great tool that a lot of people think that it is, because the challenges are going to be to make it work for the investments that you have there. And I would strongly encourage the BALLE community to learn from other people in the space, especially people like Aaron and Stephanie, and around the experience that they're having and what's working with them, to find the ways that can make your impact in your community much more bigger magnitude.
Thank you. Aaron?
Yeah, I would tell folks to keep an open mind with this and to stay engaged. I think it's important to, again, recognize it's not a program, and I don't think folks ought to expect someone to figure this out for them, right? That you've got to figure out the model that works best for the needs in your community and the investor base that is willing to support that. And it's not going to look like other tools that we have in our sector. It's going to be driven by sort of the folks who get up, figure out what the need is, create a product around that need, structure an offering around that, and then start hitting the streets to raise that capital. And so if you want your community to sort of benefit from this thing, sort of it's incumbent upon everybody to sort of think about what is the need of my community and start there and sort of back into what the product ought to be and then where you might get the capital. I think don't be shy about asking, particularly your local funders, for that sort of alignment. But this is not the kind of thing that's going to sort of rain down capital. You have to go out and get it. But it's also not the kind of thing that you should change local priorities for, because it's not that kind of tool.
Mm-hmm. Thank you, Aaron. All right, Stephanie, last final thought.
The good news is this works without opportunity zones. So whatever you want to do, focus on growing your philanthropists and investors to invest in place-based impact investing. And for, I believe it was Nancy in Florida, there are opportunities. We just have to provide you the technical assistance and find the right local impact-based real estate developers who can think through these shared models. So I would say use the opportunity, do what we're doing. Use the opportunity zones as a way to have a fun national conversation, knowing that even if it disappeared tomorrow, we can still keep growing place-based impact investors to invest locally. So get committed to doing that, and then the opportunity zones will hopefully be frosting for that existing work that we're doing. So don't think of it as turning things sideways, but as an opportunity to catalyze place-based impact investing conversations that can happen without the zones.
Great. Thanks, Stephanie. And I know Catherine has some final notes for you all, but I just wanted to thank you again, Aaron, Tomas, and Stephanie, for taking the time to join us today and share some of the insights that you have about opportunity zones. And I also wanted to thank everyone for joining the call. We're really happy that so many folks from our community were able to participate today. So, Catherine?
Yeah, I echo Leslie's thanks, both of the speakers and of the folks who participated and called in today. We're grateful for your time. I also wanted to offer that if you have any feedback about the presentation or conversation, whether there's topics that we didn't dive into enough that you'd like to dive into more, whatever it might be, just shoot me an email. And if there's enough interest around a specific topic or subtopic of opportunity zones, I'm happy to coordinate another discussion or another call with everyone. So thank you again. We really appreciate your time today, and I hope everyone has a good afternoon.
Excellent. Bye, everyone. Thanks.
Bye.